There's a real estate crash coming. There's a housing bubble. Watch out for inflation. Watch out for a recession. Foreclosures are up 129%. Hi, I'm Mike Drutar. I'm a real estate broker in Kona, Hawaii, and I'm here to talk a little bit about the housing bubble, or if there really is one, and what it might look like. There's a lot of information out there right now that really, it kind of catches my eye. If you're searching real estate on YouTube or on the internet, it seems to be that there are a number of people talking about a possible housing crisis in the terms of we're in a bubble, which means we're going up and we're going to go over a cliff and we're going to come down sharply. I want to talk about what a housing bubble is and how this market is different from when we actually had a housing bubble back in the early 2000s, and why people might think this is a housing bubble now, and the three things that I'm looking at to determine if this market is going to change at some point. So we've gone through almost 2 years now of a really big bull run. We're seeing 20% increases, and it's pretty amazing. This thing has been going on for a while. It shows no signs of letting up now. But we are in an inflationary cycle right now, and so there are people out there trying to slow this market down, which is probably a good idea. And the one thing that they can do to slow this market down is to increase interest rates. So the thought is out there that this increase in interest rates, along with other factors, are going to lead to a severe collapse in the housing market. Hence, it's a bubble. Now, if you search housing bubble on YouTube, you're going to see a whole lot of, really fear-based thumbnails. I put housing bubble in my thumbnail, hopefully to get your attention. But usually it has something with flames and a lot of red arrows in different directions, and usually some guy with a really worried look on his face that's meant to cause you distress and alarm and hopefully get you to click their videos. What I want to do is dispel some of the myths that they're putting out there, because they're really not doing a good look at the data. They're just trying to get you to click on their videos. Their business is making YouTube videos for the most part. I'm a working real estate broker here. I'm out there every day. I'm reviewing contracts every day of the week. I'm seeing what's actually happening in the market. That's where I make my money, not off YouTube videos. So I don't really need to get a bunch of clicks. I don't need to make an alarming headline or use alarming tags or use alarming thumbnails to get people to look at it to make money to pay my bills. I pay my bills by representing buyers and sellers every day in this market. So I have a really good perspective, I think, on what's actually going on out there. Now, why do we think there is a housing bubble? Why are you searching housing bubble right now? Well, the reason is probably pretty well founded. You know that prices have gone up quite a bit in the last few years, and you're thinking, I remember last time this happened, prices were going up and then they crashed back down, and it's called recency bias. The idea is that just because you saw something before and you're seeing something similar now, that they're going to have the same outcome. I think if you want to talk about outcomes, that's fine, but before you talk about the outcome, let's look at how this market may be similar or different from when we saw a big run-up before in, say, 2005, 6, and 7. The biggest thing to remember is that the housing market, whether it goes up or it goes down, that is a result of various factors, and that is specific to every market. So this market is going up for a specific reason, and the last market went up for its specific reason, and it went down for its specific reason. Just because the last market went down doesn't mean this one's going to go down in the same way, especially if the reason it's going up is completely different. Without going into a hyper deep dive as to what happened in 2006 and 7 and the eventual real estate crisis, the short answer is that people borrowed money that they didn't have. The idea was that with prices going up, they would just sell it in a few years and make a profit, having done nothing and paid almost nothing. It was a speculative market. People weren't buying homes necessarily to live in for a long time. They were just buying homes for a little while with teaser adjustable rate mortgages and what were called ninja loans, no income, no job or assets. Stated income loans. They could literally just lie on their loan application, use virtually no money down, and get a house, sometimes even with a negative amortization loan where the loan balance actually gets higher every month because you're paying even less than just the interest. This led to a market where people were buying homes with no real intention of using them. Eventually, everyone was doing this, or at least a lot of people were doing this. And when things changed a little bit, that long-term outcome goal that they had of selling a property for more was no longer possible. So what did they do? They just walked away because really they didn't have any money in it. It was all someone else's money. Things are different now. After Dodd-Frank and a lot of changes with Fannie and Freddie and how mortgages are done, we see now that most buyers have quite a bit of skin in the game, usually 20%, and that's a big difference from before. So the number one thing that makes this market different is that the people who are borrowing money are much more well qualified. They've actually been checked out in terms of their financial ability, and they're paying their mortgages. The other big difference with this market now is there is so much cash coming into this market. I pulled the numbers in here. In 2006, in my market here in Kona, Hawaii, 16.9% of all houses and condos that were bought through cash or 1031 exchanges. Let's take a look at 2021. 48.5% of all houses and condos bought in my market were cash or 1031 exchanges, which are virtually the same as cash for the most part, though some will be financed. A large percent of the people who did borrow money weren't borrowing 90% or 100%, they're borrowing 50%. I've seen a ton of transactions out there that are listed as financed in the report, but actually had about half cash. So with buyers having a lot more skin in the game, there are not going to be the strategic defaults that we saw back before in 2008 through 2012. Difference number two, the people who are buying are not speculative flippers. That was one of the big things that we saw in 2005 and 2006. It's been years since I've had a client say, I want to buy this property, I want to sell it in 2 years, and I want to make X percent. I haven't seen that. That just hasn't happened in a long time. But I did see it a lot in 2006, and that's what a lot of people were actually doing back then. That's a much different buyer profile than we see right now. Okay, so we know that the causes of the market run-up that we saw in the early 2000s is really different from what we're seeing right now. What we're seeing right now is people actually changing how they live and also changing how they invest. People are putting money into real estate as a long-term hedge against inflation, which is pretty much the playbook that you do in an inflationary cycle. And we're also seeing that people just want to secure their cash with real estate. People are changing how they vacation, and that has made the vacation rental market much more attractive for a lot of people. People are also changing how they work. With the expansion of remote working, we're seeing a lot of people come out here to my market in Hawaii working from the mainland. This is also happening in a lot of other markets. Basically, people can go wherever it is they want to go. But the important thing to remember is they are going where they want to go. It's where they want to live, and it's where they want to buy. This isn't just people making purchases for the heck of it. This isn't people making purchases in the speculative way. They're actually taking a very thoughtful approach as to where they want to be, and they're buying at a place where they want to actually stay, regardless of if they work there. Okay, I will say, however, this 22% run, that is not sustainable, and I hope that changes very quick. Now be careful. You're going to hear people in the next year talk about this market as though it's going down when it's really just decelerating. So, for example, we went up 22% at the end of 2021. If at the end of 2022 we go up 12%, they're going to say, look, there's a 10% decrease in the housing market. They're going to actually spin it that way. That's not what's happening. You may see a slowdown in the rate of increase, but that's not the same as a decrease. I guarantee you're going to see thumbnails at the beginning of the year, next year, talking about how the market's going down when it's really just slowing its rate of increase. Personally, I'm hoping for something on the order of 8 to 10%, but I think that's probably far-fetched. I think it's going to be in the teens most likely at the end of 2022, but we'll see. However, there are things that I think you can look at to determine if this market's going to slow down. Because if you're a buyer right now, it could be a little bit anxious to put your money into a property thinking this might be an all-time high, and what if it goes down tomorrow and crashes? That could be a very real fear for someone, and I totally get it. So I'm going to tell you the 3 things that I'm looking out for that are a little bit different from the data that a lot of other people are seeing to determine if this market is bound to change. Number one, institutional investors who have come into the landlord market, if they're liquidating their positions, that's something to really pay attention to. Now, there are a couple different types of institutional investors out there. Some companies like OfferPad or Open Door are offering to buy a property from you. They're going to fix it up a little bit, turn around and sell it. It's institutional flipping. And that works okay in a market like this when you're seeing 20% increases year over year. I'm not sure that business model is completely sustainable if you have a more flat market, and certainly if you have a market that's going down. I have yet to see if that's going to work. But the other institutional investors that you really want to look out for are companies like Blackstone. There are a lot of institutional investors that are buying homes in certain metropolitan areas, and they're becoming large landlords. Now, we're not seeing this in my market here in Kona, Hawaii. We're too small. But in places like Phoenix, Las Vegas, Dallas-Fort Worth, you are seeing institutional investors coming in there and being landlords. And they're also propping up this market because that's an increase in the demand at a time where you have very limited supply. Now, their long play is not to sell that property in 2 years or 5 years or even 10 years. Their long play is to continue to own that property in perpetuity and collect rents for a very long time. But if for some reason something changes or their algorithm or their experts think there are big changes, you may see them begin to liquidate their position. That is something to keep an eye on. If you see that, you could be seeing a bit of a change in the market with an expected devaluation. They're not in the business of losing money, so if they think they're going to be losing money, you'll see them sell ahead of it. The second thing I'm looking for, and this is a tough one, if the Fed misses and we have a really hard landing from this inflationary cycle and it spins us into a recession. Now, this is a real thing that can happen. After the recession that we had that started with real estate in 2008, we had a very long, sustainable, but ultimately very unsatisfying recovery over the course of about 8 to 10 years. That was the soft landing that was being talked about, and they did a really good job of making sure that things were really smooth and sustainable for a long time. And we had a very stable and sustainable housing market and economy over that time. But right now, our inflationary cycle has gone through the roof, and we're going to talk about why in a few minutes. They're needing to bring that down, and because it's gone up so much, it's going to be hard to nail the landing just right without there being any repercussions or a bounce off the bottom. It could be really weird at some point for a while. The Fed is getting very aggressive on increasing interest rates. I think we're expecting to see something like 7 increases in 2022. With some of those increases being a half point, not just the quarter point. So they are really getting pretty aggressive about stemming this inflation as quick as they can and slowing down our spending. Problem is when you have big changes like that, it can be hard. You can overcorrect. Think of it like driving a car on an icy road and you lose control a little bit to the right and you try to correct and lo and behold, you overcorrect and now you're worse off than you were when you started. That's a real thing that can happen when they're playing with the economy. So the second thing I'm keeping an eye out for is if the Fed misses this and swings us into a recession. And number 3, this is the thing I'm actually keeping the biggest eye on, and that is the M2 money stock. This is a chart I'm putting up now. The M2 is a total of all the money in circulation. And you can see in this chart that the thing had been picking up over the last 12 years, pretty stable. And then we had our big global event that we all saw about 2 years ago. Once Congress passed the CARES Act and CARES Act 2, they released incredible sums of money into the economy. And looking at the chart, it really goes almost vertical overnight. The result is that right now we have 40% more money in circulation in February of 2022 than we did in February of 2020. And remember, we're Americans here, okay? We spend money that we don't have. You can bet your butt that we're going to spend a lot of money if you give it to us. So right now we have $21.8 trillion in the economy. We're going to need to see that line, that chart, flatten out for a while to know that we're going to see a stable amount of money, and that will stabilize the overall spending in real estate and every other market as well. As long as you see that chart continuing to go up, that means more money is coming into the market or into the economy. More people have money to spend, and people are going to spend it on all kinds of things, RVs and boats and real estates and vacations and anything that they can spend it on. With supply chain problems, with limited productivity that we're seeing in the last couple of years, they're going to compete with each other for those commodities, and that's going to keep pushing the prices up. If we continue to have that supply of money, you're going to continue to see all commodities, including housing, going up. If you see that line flatten out, people are going to stop spending money quite so freely in all commodities, including real estate. That will tell you that our market is going to begin to flatten out. So those are the three things I'm keeping an eye on to determine if this market is going to change. I'd like to know if you have other things that you're looking at to predictively tell if we're going to change. I'd like to know where you think the market's going to end this year. I'm hoping for 8 to 10%, but I wouldn't be surprised if it's in the teens. I really hope it's not over 20%, but I've seen that prediction out there as well. I want to know where you think it's going to end up. I hope you got some value out of this. If you did, come back, watch some more videos. I got some here in the corner for you.